Welcome everybody to this week's Rice Report. My name is Eric Rice. I'm your host, obviously. We try to do these things once a week, but at certain times it gets a little difficult with work schedules and things like that. Just to preface this by saying I make no financial incentives. I don't even run ads on here. This is information I feel the general public should have, especially investors or people watching their pennies, that the news system or the media system we have at large just simply doesn't provide. All we hear is puppy dogs and rainbows. We get talked to like we're children who can't take bad news. So I'm not going to say anything's good or bad news because there's opportunities in everything, but it's pretty apparent right now that there's a lot of bleakness in the market, things that need to be addressed so that at least if nothing else, if I leave this video today and you go home and talk to your significant other, at least you have the ability to handle your finances knowing some of the full spectrum information that's available today, and there is a lot. So we will start doing these a little more frequently because there's just so much information breaking, and to be quite frank with you, most of it is fairly useless or just bold-faced lies. And I say that 100% with conviction. I've been saying it for the better part of a year and a half that the reports that we're getting from the government are nonsense, that they are hocus pocus, they are an illusion in front of us, designed to appease an entire society into thinking economies are good so you live your life like normal, when in essence you should be making different styles of investments. You should be managing your money and protecting your wealth as strongly as you possibly can. Now there's been a big push on the internet, a lot of these things popping up about how much men think about the Roman Empire. And I think it's important to note that this is probably not a coincidence. We are living in a version of the Roman Empire. I don't believe it ended, it just switched from country to country. But what we're living in right now is very similar to the Roman Empire. We have a completely depraved society that's now promoting cross-dressing, transgender, all these things. This was very common in Rome as well. They experienced extremely high inflation, poor government transparency, and massive amounts of debt, which ultimately led the most powerful empire on planet Earth to be conquered by barbarians who didn't even have steel swords. So let's protect ourselves from that type of event if that is to come. Now, when I talk about government reporting and it being pretty much nothing, bad news covered up with numbers, we have to look at two important ones, the CPI or inflation and the jobs report. But it's important to note that the Bureau of Economic Analysis actually just did a full breakdown of the last 3 years of Bidenomics. And the numbers came back essentially saying what I've been saying for a better part of a year and a half. The numbers they're telling us are manipulated and they're not the truth. Barclays, of all places, Barclays analyst team actually just published an article stating that in order to save the bond market, which has been on triage for the better part of a year, in order to save the bond market, the stock market must crash. You have to look at these small articles. There'll only be one or two every now and then. They give you good indicators as to what the reality economically is. And Fox, a business of all places, actually came out and said that the trends for 2024 are not recessionary, they're depressionary based on inflation. So let's talk a little bit about inflation. Yesterday, the CPI numbers came out at 3.7%. While that sounds, it's still higher than projected, so it's still increasing. But while that sounds like it might be a decent number, you have to look at the reality behind inflation. First and foremost, inflation is year over year. So those are numbers for September. So September of 2023 versus 2022 was only up 3.7%. So what was 2022? 2022 was 8.2%. 2021 was 5.4%. Giving us almost 18% inflationary trends in the month of September since 2021. That's the reality you live in. So while we are seeing inflation quote unquote fall, we're seeing prices rise all over the place. How can that happen? Well, in our CPI numbers, they don't include two very large indicators. Number one being fuel, the cost of fuel, and the other one being the cost of food. So whether you're fueling your vehicle or fueling your body, it's costing you more money. That's something we all need to understand. Now, there are a lot of things that are impacting inflationary trends around the world. Number one, obviously, is poor government spending, but people aren't correlating the fact that our economy is very dependent upon that government funding. About 52% of our overall economy is already tied to the government, essentially making us a socialist system without even knowing it. We also have trends around the world like mounting wars, which I'll go into in a moment, multipolar activity, meaning that people are decentralizing or deglobalizing their economies. You can look at Niger, who's basically kicked France out, who's been colonizing them for years and years, not in the way that they talk about in colleges, but truly stealing their resources from them. We have to look at those trends, and we also have to look at government spending as a whole. So I'm going to go through these things, but there is one major area of the market no one's talking about that's probably the largest danger in the entire economy right now. But before I do that, let's talk a little bit about government spending. I think that's important to know. We recently went and had an announcement saying we had reached $33 trillion in government debt, in national debt. If you don't know how that works, essentially the central bank, which is not part of this country, prints money based on demands. As soon as that money is printed, it's then collected through the IRS, also not part of this country, to collect your real taxes to pay them back with interest. That is right, America has a loan shark, and it's called the Federal Reserve. Now we've added to this. So a little over a month ago, it was released that 33 trillion was a new number. We're now approaching 33.6 trillion, which is only 0.6 when you look at the number, but that's $600 billion. We are effectively printing $1.2 billion per hour. Now, if you want to think of it in a different way, think about a football stadium, right? So the Dallas Cowboys football stadium is like $1.2 billion construction. Our government is essentially giving away a Cowboys stadium every hour on the hour for the last 20 days. This is an extremely dangerous event, and it reminds me a lot about fallen empires and about Rome. You know, at the end of these fallen empires, what happens is the governments loot their own treasury. They steal from their own people, which is why these things end up poorly. It's pretty obvious to me at this point in time that the government is looting our treasury, which is led by Janet Yellen, who hasn't told the truth maybe ever in her life. I oftentimes call her Satan's accountant. That's my own little personal nickname. So let's look at some other indicators in the economy that everyone needs to know. Bank of America, we'll get into banks in just a moment, I promise you. Bank of America recently put out a couple of really staggering bits of information. Number one, right now, 420,000 Americans are on strike. Why are so many Americans on strike? Perhaps it has to do with the declining wages. That is a big issue in this country. They've also said that they expect to see 545,000 Americans on strike by the end of the year. That essentially is the largest amount of American workers on strike since 1983, which is the last time we dealt with really high-level inflation problems. So Americans are getting poorer. You know, the article came out from Fox about us potentially heading into a depression, I think is very reactionary. Let's look at depressionary numbers. In the Great Depression, 1929, the average household income was $4,860. If you use an inflation calculator and determine what that value would be today, that would end up being about $93,000. Well, the average American household income right now is anywhere between $71,000 and $73,000. We are already in a wage depression that already exists, and now prices are climbing higher. They're climbing so much higher, in fact, that right now over 50% of Americans between the ages of 18 and 29 are living at home primarily for financial situations. Houses are getting smaller. In 2015, the average new home was 2,700 square feet. Today, it's 2,200 square feet. And the price went from, call it $200,000 to $420,000, along with mortgage rate increases. So on the mortgage side of things, we have to look at that. Right now, we're approaching, depending on what stat you look at, we're either above or right at 8% on a 30-year fixed. Now, when you look at 30-year fixed numbers, it's perfect credit, perfect income, perfect candidate, gets the lowest rate. So let's call it 8% just to be conservative. Let's look at the trend in mortgages. Right now, I look at things decade by decade. Between the years of 2000 and 2009, in 2000, mortgage rate, the 30-year fixed was at 8.15%. At the end of the decade, it was at 5.14%. In 2010, at the beginning of that decade, we were at 5.09% on a 30-year fix, and we ended the 2010s at 3.74%. This new decade, starting in 2020, began with a great rush, big real estate boom right in the middle of COVID. 3.72% was the beginning mortgage rate, and currently, we're only in year 3 of this decade. We are now around 8% on the average 30-year fix. These are very staggering statistics. Now, commercial lending is also a big factor in all of this. So if we look at commercial lending right now, I can tell you firsthand, we deal with investors where I work every single day. And we have actually had multiple investors tell us they're having a hard time getting a loan for a property that only has 10% loan to value or LTV. So what that means, if you don't know what that means, call it $1 million building that you only owe $100,000 on, meaning you have $900,000 in equity. They're having a hard time getting a loan. These are staggering things that are really happening in the world. What does that mean? Well, most commercial lenders, most of the loans on commercial loans do come from regional banks. And the reason is very simple. Regional banks specialize in understanding their region. So the bankers that understand their immediate area are the ones that generally lend to these commercial buildings. There's about $200 billion in commercial loans that are in very, very difficult spots right now. And if these loans actually fail and default and collapse, it's going to cause a big problem in the banking sector all around. Most people don't know that banks have to have, depending on the stats you look at, call it $7 in cash for every $1 that they lend out. So they have to have $7 of deposit or cash in order to lend $1 to collect interest on. And this is also a primary earnings center for these banks. So if these loans default, they lose revenue. If they can't lend, they lose revenue. And if they can't lend and they can't capitalize on their lending procedures, then deposits begin to flow out of these banks, causing collapses. So is that a reality? Because the Janet Yellen and everyone at the Fed, they'll tell you that no, the banking sector is totally fine. Well, Bank of America disagrees. Bank of America came out last week and said that they just saw the largest 2-week outflow of capital or deposits that they've seen since February of 2014, which coincidentally is the largest outflow of cash from banks in US history. So we are watching capital outflow. The International Monetary Fund, the IMF, who you should trust about as much as you trust Janet Yellen, actually came out and said that 5% of all banks globally are at serious risk with this type of interest rate environment. So the IMF works for the bankers. I would assume that number is probably more like 15 to 20% of all banks are at risk due to the high interest rate environment we find ourselves in. So let's take a look at that. If we look at the interest rate environment, it's completely predicated at the Fed. It's predicated upon inflation, which just went up. Now, how can I assume, aside from the fact that I believe that there is a takeover of this government happening, how can I assume that rates will go up again this coming month? Well, it's pretty simple. Janet Yellen is hoarding cash. You don't borrow cash unless you know rates are going up. So if we look at another interest rate hike, we're going to be looking at real teetering systems within the banks. We're looking at real possibilities of a widespread banking collapse problem. I do not care what the news says. I do not care what you think about my opinion on this because I'm regurgitating facts. My goal here with all of these small videos is to give you dots so that you can connect them on your own. And I will tell you how I connect them. I believe that we're about to see serious banking problems in 2024, if not perhaps earlier. So we've gone through the credit market, the banking market, federal spending, some of the news that's coming out about our governments. Let's talk about some things that I think are very pertinent and important to understand, like what's happening in Israel. So aside from being in a recession, like I've been saying it for long, we've been in a recession. Eventually, the NBER will announce that we've been in a recession, just like they did in 2008, 2 years after the fact, so that you couldn't prepare. What I'm seeing right now are trends in a really bad direction, and it stems from energy. So we have Israel, who's now at war with Palestine. We have Ukraine and Russia. Israel and Palestine is something to certainly watch. I know the whole world's trying to tell you to pick a side and join a gang and all this other stuff and do what you want. I'm going to look at things from an economic perspective because what I'm seeing happening in Israel and Palestine is not going to be a contained environment. We are going to see Taiwan be invaded by China. I think that's fairly inevitable at this point. And I know it's inevitable at this point because right now Congress is preparing yet another $100+ billion aid package for Ukraine, Israel, thankfully our southern border, which I'll talk about in a moment, and Taiwan. They always know stuff before we do. That's pretty apparent. But we also have to look at Iran, Jordan, Syria, and a more widespread problem throughout the Middle East that'll actually end up dragging a lot of the first world countries into this mass event that's occurring. That is going to mean serious implications for energy, which are already starting to see sabotage. We saw the Nord Stream 1 and 2 blow up, then we saw the price of natural gas skyrocket in Europe. We know now at this point in time that our government had suppressed the price here to sell it to the folks in Europe at a major premium, add it to the GDP, and tell you that everything in our economy is fine. However, that research done by the BEA counteracts every bit of that. If you remove the sale of liquid natural gas to Europe, weapons from NATO nations, and the depletion of our strategic petroleum reserve, which should be one of the more scarier events in this country, you remove those, our economy has been contracting for 2 years. It's important to see these things. So if we look at some of the similarities, the last time that Israel went into the Gaza Strip with this type of military force was 2009. Less than 6 weeks later, we saw banks collapse and bailouts occur. Now that we have the IMF announcing that 5% of banks globally are in big trouble with these interest rate environments, it's also important to note that bankers around the world are now, around the country, I should say, are now calling for a TARP 2.0. If you don't remember TARP, it stands for Troubled Asset Relief Program. This is what created bank bailouts back in our last recession. They're calling for it. The bankers are calling for it. There are literally well into the $100 trillion range of bad derivatives that are on the books of these banks. Bank of America being one of the biggest holders of bad derivatives. One of the things I would watch with this is to understand what TARP means. So if banks are asking for bailouts, which they are at this point in time, not many, but they're starting. I try to get information out before it becomes commonly known. So if banks are already calling and asking for TARP 2.0, we have to look at the Dodd-Frank Act, which I've talked about multiple times. The Dodd-Frank Act, essentially, to boil down hundreds of pages of bureaucracy, essentially allowed for bailouts to occur. TARP authorized $700 billion for bank bailout. Dodd-Frank limited that down to $475 billion for bank bailouts. And it essentially ended the bailout system, which was violated 4 times this past year. Remember, don't let them make you forget through a news cycle with all the things that happened. There have been 4 major banks that have collapsed in this country already. And they have bailed out the depositors, though not the equity holders. It's important to understand depositors are debt, equity holders are equity. The Dodd-Frank eliminated bank bailouts and opened the door for bank bail-ins. Let me explain those very simply. You give $100 to a bank, it becomes a debt on their books. They owe you $100 later. The Dodd-Frank bank bail-in system, or OP 1670, actually allows banks to convert debt to equity. So your deposit or your money in a bank could be exchanged without your permission for certificates in a dead and dying bank. I'm not saying that that's going to happen. I'm not trying to promote fear. What I'm trying to do is I'm trying to arm you. Biblically, it does say, my people perish because of a lack of knowledge. So we need to be able to share information with one another freely in open sources like this. I think it's important to note that this is a reality. It is a law that's in place, and we are already seeing major outflows announced by Bank of America, not by me. They're letting you know that this is a direction we could be heading. So if we look at the widespread wars that are occurring right now, that's going to increase government spending, that's going to increase inflation, which in turn will increase interest rates at the Fed. That's why they're saying the bond market may be bailed out from a stock market crash. High interest rates equal bad news for the stock market. So the one thing I want to do is kind of explain some of the trends that I see. Like I try to look for, since you can't trust government reporting, because let me tell you how that works. 90% of the stock market is traded based on algorithms. Algorithms take in information, they weigh it based on credibility, and government reporting has the highest credibility. So when a jobs report comes out and says we had 500,000 new jobs this month, the algorithm sees that and it buys. That's why the stock market is still so high after all of this information. Eventually that will end. But what we're also seeing right now is that same jobs report gets revised 3 or 4 months later. Oh, it wasn't 500,000, it was 189,000, but nobody notices. This has been happening for 18 months. So there's something large building there. But it is important to note some of the weird trends. A few weeks ago, I talked about the fact that I look at cardboard packaging or cardboard box sales, which are depleting. Almost everything we buy and sell is sold in a cardboard box. With government information being this nebulous or just deceitful, it's important to look at other indicators. Here's a great indicator to look at. True inflationary numbers. So if you remove food and fuel, you're at 3.7. Fuel is easy to see. You can see that trend is going to go up significantly, especially with war that may spread throughout the entire Middle East. But if we look at trends that we can actually see, car insurance is up 18.9% inflation. Rent, 7.4. Meat and poultry, up 4.8%. It's getting more expensive to buy meat. Now, how expensive? Well, in Germany, they are now at a 34-year low of meat consumption, which is why the World Economic Forum is trying to push you to buy bugs, to eat bugs. You actually don't need to buy bugs or eat bugs. All you need to do is get rid of a central banking inflationary fiat currency system. That is truly the solution. But I digress. So where do we go from here? This is a lot of information to soak in, a ton of information to soak in. Here's what's important to note from me. War is a business. War is an industry. War is a machine. In general, when there is a war, the same people back both sides knowing that they'll win. How can I justify this statement? Well, BlackRock, State Street, and Vanguard, the day that Hamas terrorized Israel, they made $3 billion in the stock market with their holdings of Northrop and all the other defense contractors. Defense contractors are salivating at this because they make a ton of money while the rest of us pay the price. Peace is always the solution. It always has been and it always will be. How you get there is always different. So what do we look for from here? This is a difficult scenario. You have publishers out there, multi-billion-dollar companies saying a stock market crash is necessary to save the bond market. You have Warren Buffett going out there and saying you have to figure out how to survive in real estate to 25. You have publishers out there saying right now that we're entering a depressionary state. All of that stuff has already been talked about. Where do we go from here? What do we see? Well, let's look at the market today. Today is October 13th of 2023. We can see fears spread throughout the country. We obviously have about 12 million people in this country who are now new mouths to feed, new housing, new clothing, a lot of economic problems that are coming, but a lot of fear about global jihads and all these other things. These are distractions from the economy. They're important things to note and pay attention to, trust me. I do it in my other podcasts frequently. But from an economic perspective, as an investor or just someone trying to feed their family, where do you put money? Well, I don't think cash is safe anymore because banks may collapse. And to be honest with you, the crown jewel of our enemies, of the American enemies, is to destroy the dollar. BRICS just sold off $17 billion in US Treasuries last month, and they plan on doubling that this month, which is why the Treasury is also hoarding cash. They're going to have to buy their own debt. This is a very important time frame in American history, especially if you plan on thriving through difficult times. So what we're seeing right now is a massive run up in oil. Oil is up about 5.5% today. Gold is up about 3.25, and silver is up 3.9. You can also look at indicators like Bitcoin and other cryptocurrencies to watch what we're looking for. In times like these, we are watching a commodity super cycle get built through poor government policy, poor economic decisions, and at the end of the day, a lack of transparency between those and their civilians. So don't get caught up in the hype. Don't read anything that comes out of any market watches or any of these other websites telling you that they see bullish trends in the stock market or it's a good time to buy bonds or treasuries. Right now is the time to hold physical, tangible assets, especially with a pending threat of potential bank bail-ins. I can tell you moving forward, I believe in 2024, what you own is what you can what you hold is what you own, and the rest of it is a bit of a gamble. So I would focus our attention on the largest deficit in the entire industry. With all these inflationary trends that we see right now and the push for EVs and all these other things that are out there, the largest threat to an economy is a lack of investments in natural resources, commodities. So if you're going to place your money anywhere moving forward, I would look for natural resource, commodity-based investments that provide tax advantages, because with the national debt where it is, taxes are going up. But remember, tangible goods in difficult times. We're already in a recession for sure. We may be in a depression. We are, at least from an earnings standpoint. So it's important to note that during those times, what you hold is what you own. Have tangible goods. Be prepared for what's coming moving forward. I hope this little 23-minute video provides you the information you need to make better decisions in your life. And until next time, I'm Eric Rice. God bless you, and God bless this country. Thank you very much.